Hello, I'm with Professor Simon Johnson. He is the Ronald A. Kurtz Professor of Entrepreneurship at the MIT Sloan School of Management. Simon, thanks for being with us. In the mid-1990s, I was working for the IFC, and when things got really bombed out, I suggested to them that they set up a VC fund trying to capture some of the tremendous values that were left in Asia after the wreckage in 1998. And the general response I got was, no, we don't want to go near the place, it's rife with crony capitalism. And I couldn't help but think about that in light of what's happened in the last few years in the US. And you being formerly with the IMF, must have a similar sense of deja vu about all this problem.
Yes, absolutely. I think that's a very good comparison. Many of the problems that became manifest in Asia in 97, 98 are actually the same problems that we have today in the United States. A relatively small elite has become too powerful, and powerful in ways that distort the financial sector, cause a great deal of risk, and damage the rest of the economy.
And it's interesting because the last time we had a situation that was similar to that, of course, was the 1920s, when we had the fire sector, finance, insurance, real estate. I think profits accounted for about 40% of total profits in 2006. You had the same thing in the 1920s. The difference being, of course, that after the Great Depression, we had a fairly robust regulatory response. I think it's fair to say that you, amongst others, have pointed out that it's been lacking this time.
That's right. Certainly the response has been nothing like what happened in the 1930s. The financial sector, of course, was a big driver of what happened in the 20s and into the 30s. It was a much smaller part of GDP back then. It was 1, maybe 2% of GDP. It reached closer to 8% of GDP. So it became a bigger sector, and a sector able to do arguably more damage going forward than even was possible in the 1930s.
And yet, there seems to be a real problem about political capture this time around. We have, it seems, let a good crisis go to waste, to paraphrase Rahm Emanuel.
Well, I think it wasn't wasted. The crisis wasn't wasted from the point of view of the bankers. I think they did very well out of it, and it was a nicely run scam or scheme on their behalf. It was wasted by the rest of us. It's true. We have not reined in their power.
And do you get a sense now that we're 5 years on, obviously public revulsion has not abated. If anything, it's got higher. And even some of the so-called star bankers like Jamie Dimon and JP Morgan have proven to be vulnerable and subject to the same kinds of depredations as some of the other banks. Do you get a sense that the political and economic climate is changing somewhat? Is it more favorable to the types of things you were advocating in your book?
Yes, the climate is definitely changing, in large part because the banks have been proven repeatedly to be somewhere between incompetent and unwilling to manage their risks appropriately. It's not just JP Morgan Chase and the so-called London Whale, it's also HSBC and Standard Chartered with their money laundering, it's repeated problems around Citigroup, it's many things that we learn happen around Bank of America and Countrywide, which they bought. And every time that there are revelations of this nature, people begin to understand more clearly how the financial sector has really come to operate.
Although unfortunately it still seems to be a case of both too big to fail and therefore too big to jail.
That the Attorney General of the United States said in recent congressional testimony that his Department of Justice cannot bring criminal charges against the largest financial institutions in the country. So equality before the law is no longer with us.
And who do you think was driving that? Was that a decision that was driven by the Geithner Treasury, or do you think it was a decision taken at the DOJ?
Well, that's a fascinating question, and both sides are pointing fingers at the other. I think Lanny Brewer, who is head of the criminal division, working with Eric Holder, the Attorney General, largely decided for themselves. But the interesting question there is, on what basis did they decide? With whom did they consult? What are the metrics they use? Are there rules that are written down? Is this something they make up in the shower every morning? It will be good to know this sort of thing.
Do you have any personal thoughts about that, or do you want to name names? Or
well, look, I think that they're making the whole thing up on the fly, and how they decide that these people are too big to jail and these people we can go after seems to me, in the current situation, to be somewhat capricious and not subject to the sort of accountability that you expect and hope for around the American justice system. The Treasury Department under Mr. Geithner, without question, was sympathetic to the view that you should leave the big banks alone. And we'll see how the Treasury Department is
whether it changes under Jack Lew, yes.
Right.
Well, let's shift the focus a bit to Europe because it's not 13 bankers there, maybe it's 13 finance ministers to paraphrase, but what we do seem to have the same problem. And in many respects, Cyprus, I think, highlights again the dangers that you pointed out because we had uninsured depositors taking haircuts. Of course, at one stage it looked like the so-called insured depositors might take haircuts as well. But for me, what's been interesting is that the political response has been, isn't it terrible that some depositors have had to take haircuts, or or there's been a big debate about that. But there's been less of a question about the activities that led to this problem in the first place, that put the deposits at risk. We find out that deposits are simply now not a risk-free asset that you put at your local bank, but they are in fact a branch on the creditor's tree. And I think the question has to be asked: are the range of activities that are being allowed by bankers consistent with this mandate to safeguard deposits?
Well, that's a great question, and I would probably expand it and ask whether we have enough equity capital in any of our banking systems. The Cypriot banks, if you look at the liability side, they had mostly deposits. They had very little equity and very little by way of subordinated debt or other kinds of bond issues. It was all deposits. Now, they made some investments that they claim weren't too risky by buying Greek government debt. Of course, it turns out to be very risky. And when they have those losses are big relative to GDP because the banks are big relative to the economy. How are you going to absorb the losses? Who's going to pay for that? Is it going to be the taxpayers? Is it going to be the pensioners who cut pensions? Is it going to be the depositors? There are no good choices in that moment. And that's why I think bank regulation, but also thinking about bank size, individual bank and the size of the bank system relative to an economy becomes increasingly a compelling question.
And that's why Cyprus, I think, is an interesting situation because a lot of people say, well, it's an outlier, its banking assets were about 800% of GDP. But actually, if you look at the European Union as a whole, its banking sector relative to the size of its GDP is still multiples beyond the US. I mean, if we've got too big to fail banks there, I mean, they've got absolutely gargantuan banks which are too big to fail. I mean, even in Germany, I understand that the ratio is about 400% of GDP as far as banking assets in relation to GDP.
Well, you're right that the Europeans have much more of a banking-dominated finance model than does the United States, and their largest banks are bigger relative to their individual economies. If you divide by the Eurozone as a whole, all financial assets divided by the Eurozone, they're somewhat bigger than the United States, 2 to 3 times bigger. No, they're not eight times bigger, but in individual countries, there are even greater imbalances. And they also bought massively, more than the United States, into the Basel II way of thinking about measuring risk and allowing the banks to determine for themselves what's a safe asset and what's a dangerous asset. But this is a very difficult combination for them now. They have a lot of mismanagement of risk and balance sheets that are big relative to their economies. And the sovereign debt crisis, of course, is not yet over. And
it's not over, and that's an additional complicating factor because, of course, in the US or in Canada or the UK, when you have a deposit insurance guarantee, as you do, it's much more credible because it's ultimately backed by Treasury, say in the US, or the bank, the federal government in Canada. So you can make the kinds of deposit insurance guarantees which people can credibly believe. Whereas in a country like, say, Ireland, when they first made a blanket deposit insurance guarantee, people started doing the numbers and saying, well, wait a minute, their banking system assets are 500% of GDP. How can they possibly do that?
Oh, that's right. Of course, the FDIC, to be clear, does ultimately draw upon its ability to levy the financial sector. But if that levy is not available, for example, if the entire financial sector is under stress, they do have access to
they had a $500 million credit line from the Treasury,
right,
which they didn't draw on, but I think they didn't, precisely because they had that credit line, they didn't have to draw on it. But you don't have anything comparable. And it seems that the ECB is slowly moving in that direction with a Euro-wide FDIC, but there does seem to be opposition from Germany.
Well, I think the Europeans have not made much progress in terms of unifying the banking system and providing with sensible deposit insurance, which isn't just about insuring deposits, it's also about having rules for who gets paid what amount when a bank fails. What's the order of precedence? So what happened in Cyprus was quite different from what people had expected based on what they'd seen in other banking situations recently, including Greece and Spain. So do the Europeans now have clear rules, or are they just making this up as they go along, that's a big question in terms of generating uncertainty for themselves and for the world.
And here in Asia, do you get a sense that they've learned at all from our crisis? Have they? Because I still get the sense, talking to people, say from the People's Bank of China, that they still buy into this the so-called Washington consensus model, financial deregulation. They still talk about the virtues of full capital account convertibility. It's almost as if the last 15 years haven't happened. I mean, they've been bumps in the road, but I don't get the sense that they've really begun to rethink their banking model at all.
Well, of course, their banking model has its problems in its current incarnation, so it's not clear to me whether they're better off sticking with what they have or trying to make some further adjustments. They can have severe difficulties either way.
You mentioned earlier, you talked about how there's a greater need for higher capital buffers, and there's been a number of people that have mentioned that as well. William White of the BIS has been a prominent spokesman of that. Anand Admati has been another. I wonder, though, whether the liability side of the bank's balance sheet is really the best way to regulate. And by that I mean you increase capital buffers as a response to a pre-existing problem. But actually, shouldn't you be looking at the activity which generates the problem in the first place, and therefore regulate the asset side of the balance sheet? In other words, what the bankers themselves can do.
Well, I'm not sure these ways of approaching the problem are substitutes. I think they're probably complements. And the key point in terms of the liability side is the extent to which the banks fund themselves with equity rather than debt. They should have enough equity to absorb the kinds of risks that you can reasonably expect over the cycle. And that's not 2, 3, 5% of total assets. It's much more like 20 to 30 to 40% of total assets. That's where we should be trying to push the financial sector. Now, it may not be sufficient, but I think it is necessary.
And of course, they don't want to do that because that doesn't help their profitability very much. And they have used those profits to buy as many people as members of Congress as possible. I mean, Dick Durbin had the comment in 2009 that the bankers own this place, and that doesn't seem to have changed.
Well, the big banks are very powerful. It's an important lobby, there's no question, and they do spend a lot of money. That's not the only lobby, and increasingly other parts of the financial sector, the small banks, for example, hedge funds, begin to object to what the big banks are doing, and I think the non-financial sector will eventually get on this as well.
Because and that's a good point, because of course what's really happening is in the US we're really talking about 4 or 5. Well, we're talking about 13 bankers, as you say, but we're talking essentially about 4 or 5 banks that have about 50% of the entire deposit base in the US, and they of course are creating a situation where she's penalizing the unsystemically dangerous banks, these 6,000 community banks and small retail banks who fund themselves via their deposit base and who are losing deposits and therefore seeing their cost of wholesale funding go up because a depositor rationally says, well, I'm going to put my money with Wells Fargo and JP Morgan because they are too big to fail. So that throws out its own kinds of distortions.
Absolutely. This is unfair competition, it's an uneven playing field, and the small banks get this and are increasingly objecting to it.
Let me ask you one final question. We're called the Institute for New Economic Thinking. Do you have any thoughts of what we should be doing, what kinds of new economic thinking we should be embracing to be consistent with our mandate?
Well, at least with regard to the kinds of issues that I work on, INET has been incredibly helpful and supportive, developing a network of people who are thinking about the financial sector in a way that is different from the convention. Now, it's an interesting question whether it's a new way of thinking or going back to old, sensible first principles. Perhaps, but still it's new relative to the orthodoxy that prevailed in the run-up to the crisis of 2007, 2008. So I think on this issue, both in terms of legitimizing the intellectual agenda, bringing people together, providing a framework within which technical people can confront these realities and say, oh, the banks are just out of control here, we really have to rein them in, and here's some sensible ways to do it, that is an incredibly useful contribution to INET.
And you've been a very eloquent voice in support of that, and so we ought to thank you for the service you've rendered to INET as well, and thanks again for being with us and agreeing to be interviewed. It's been very enlightening. Thanks a lot.
My pleasure.